European economist at Citi. He joins us live now from Frankfurt. So just in terms of overall the picture here, 6.1% in terms of the headline number for inflation. That's certainly better than what it was. Good in principle, but inflation certainly remains a problem in Europe.
Indeed, of the large components of inflation, energy, food, consumer goods, and lastly services, I'd say three are now firmly on a downtrend. So inflation has been downtrending for a while. The Russian energy crisis or the Ukraine crisis, that impact is fading. Food inflation, you mentioned, that was actually the big surprise this time around, that it came down a bit more than we had expected. Goods, the supply chain disruptions of the pandemic, that's over. The euro has recovered a little bit. So on that side, we're also expecting a downturn. The big unknown is, when is services inflation really going to peak? It came down this month, but that was probably because of a statistical quirk around German train tickets. But if you account for that, it probably was still rising. So we're still looking for the peak in services inflation. That's the most important now.
So overall, just in terms of the good news coming from the headline number here, what does this change, if anything, in terms of the ECB's calculus as to when to pause rate hikes?
I think what the inflation data shows is we're in the fine-tuning phase of this rate hike cycle. There's no longer a need for big 50 basis point steps. It's now a question of whether it's 1, 2, or 3 more rate hikes. By the end of the summer, they're certainly going to be done. And I think it's increasingly the question when the ECB starts becoming forward-looking again. There's a lot of growth data recently in the euro area, which is disappointed. So the questions are going to increasingly become, to what degree monetary policy is actually already stepping on the brakes and, stopping the economy from growing, and whether we might be headed for a recession sooner or later. So I think that discussion will start over the summer.
So you anticipate what, two more rate hikes?
Well, we definitely expect 2 more. We've got one penciled in for September, which would take the headline or the policy rate to 4%. I think increasingly with the weakening in the growth dynamics, that's becoming risky. It might just be 3.75% in July. But the key question is increasingly going to be, when are they going to cut? And that we think is going to be some time away. We've got that in the second half of next year.
Just in terms of headwinds here, how much of a concern, obviously the labour market is still quite tight, how much of a concern do rising wages continue to be?
A concern certainly for inflation. Most of Europe's inflation was driven by external shocks, both the pandemic and its supply chain disruptions, but more importantly, of course, the energy crisis last year. That's starting to fade. What is left of inflation, what we observe in services, is partly just the echo effect of that, but partly also the fact that wages are responding to the high inflation, as you mentioned in your opening piece, with a lag. Eventually that should fade, but it's already kind of baked in the cake that wage growth is going to stay above 5% all year and probably well into next year. The labor market is very resilient. That means workers feel comfortable demanding higher wages. Companies aren't going to immediately fire them as long as the economy holds up. And that's going to keep that process going for a while. And we also have to keep in mind that higher wages, strong jobs growth means people have more money in their pocket. And now that inflation is coming down, it actually buys them stuff too. So real purchasing power is starting to recover. And that should keep consumption going despite ECB rate hikes. And that's making it difficult for the ECB to cool the economy.
All right, Christian Schulz, live for us there. Thank you so much.